the time the market goes up? And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out.
Whoa. It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Okay, welcome to my podcast. So, we're going to talk about today, why is it that the big banks are getting crushed and the small regional banks are really doing well. Also, we're going to identify what is it, which indicator really tells us the truth that we're going to see a crash. When you listen to these people, these jibber jabbers on these TV shows, they're not telling you the truth, okay? I mean, if you listen to them, you get confused. There's nothing confusing in the scenario what leads up to a crash. Every crash we've had since 1929, the same things happen. There's a certain scenario. Everything falls into a neat space. And as those fall into a neat space, you finally hit your crash. They never change. What changes is the stories, because they keep on trying to get you to buy on a dip and cost average down, and they just lie to you, okay? So we're going to talk about what is it? How do you really know that it's over? There's one point in all the crashes since 1929, you could bet, you could put your house on the line and you'd win. And we're going to go over that. But first, let's talk about the banks, because the banks is the center piece of our financial empire, reality, whatever you want to call it. They're the center. They're right in the middle. They're the big oak tree holding everything up. So what is happening is this. The big banks, they rely on IPOs. They rely, when you take the biggest banks, JP Morgan, Goldman Sachs, Citi, Wells Fargo, the five largest banks, they're struggling because they make money not on, you trading a stock. They make money on IPOs. They make money on everything they make money on. It's not happening in this environment, is what I'm trying to say. So when you look at the big banks and the big earnings come out, it's not the retail investor that's helping them. It's the IPOs, the mergers, the acquisitions, the underwriting, the trading revenue, yes, but not the trading revenue from the retail investors, the trading revenue they do for all the pension funds and so forth. So none of that is happening right now. So that's the problem. I mean, IPOs, forget. Mergers and acquisitions, forget. In fact, large companies, they're cutting way back on what they're borrowing because they can't borrow anymore at zero interest rates or quarter point. Those days are gone. They're borrowing at 5-6%. And they got a lot of loans out there that they have to roll over from, let's say, 1% to 5%. But that'd be okay. But what's going on is, if you aren't doing mergers every day, that's their big money, mergers, putting companies together. That's what Wall Street's about. Wall Street's about, there's one purpose for Wall Street. Everybody gets together, puts their money in there, and it's to fund companies, to grow the economy, to grow our economy by funding people who can't go. Like, for example, when you bring a company public, you reach a point that all of a sudden you've got about 12, 15 banks you're dealing with, because not one local bank is big enough to take care of you. And so it gets really, really complicated, because now you're spending 3/4 of your time, instead of growing the company, 3/4 of the time running around to bank to to keep everybody satisfied. So you're forced to go to an IPO, get rid of all those banks, then Wall Street will fund you, and your life's a lot easier. It used to be, no more, but that's what's going on. So once they cut back their IPOs, their mergers and acquisitions, their underwriting, and now that most IPOs are frozen, they make big money on IPOs. So that, and even the trading volumes are down big. Okay, and I'm not talking to retail investor. I'm just talking the commercial, the institutions, they're trading. And so again, the bottom line is they can't widen what they call their net interest, their interest margins, because meaning that what they pay for a deposit, what they pay you for your savings, what they pay you for credit, for money markets, it doesn't match anymore compared to what they now earn on loans, on mortgages, on credit cards, and so forth, on business loans. It's upside down. So the big banks, because they're not, and usually that's okay if it's upside down, as long as they're doing mergers and IPOs, they're making big money. So even if they're a little upside down on their mortgage loans and that little business loans and so forth, it doesn't really matter. But not now. Now they're upside down. So because they don't have that income coming in from the mergers, acquisitions, IPO, that it's a big pile of money. So over here, when they weren't making money on this stuff, they had enough money to go cover it and mask it, no more. That's why they're getting slammed. Now let's go to why the regional banks. Regional banks, their business model is totally different than the big banks. Their business model is all about, again, car loans, small businesses, all those little things that your regional bank does for your businesses in town. Okay, so, but they have a different situation. They're making a lot of money, okay, on the local lending, okay, and their deposits are coming in doing very well, okay, compared to what their in other words, the interest that they're bringing in is doing a lot better than commercial banks, because they got all these deposits coming in. So that you got all the deposits coming to regional banks, and they're still making money on mortgages and car loans and small business loans. So they're doing well, because if now let's say the small regional banks, most of their income was coming from small business loans and nothing else, they'd be in trouble. But they're not. This environment really helps the small businesses, and they're just getting what they pay on CDs and all that is hardly nothing compared to what they're charging on the other side. So they have their costs down. Think of it this way: their cost is down on deposits. Okay, their deposit spreads and small business loans and all that. So when yields are falling, they're benefiting. Okay, they're benefiting. So their spreads are there. Okay, so they got a nice spread, making nice profits. But the big banks, that's not their deal. Their deal is mergers and acquisitions, and their spreads are upside down. So what we have going on in this environment is really benefiting the small banks. So that's why your small banks are doing terrific and your big banks, because there's two different business models. To put it simply, the business model for the big banks, not working. Just went upside down, not working. They're getting crushed. The business models for the small regional banks, because yields are falling, falls right into their menu, okay? It works beautiful for them. The more the yields fall, the more money they make. The big banks, the more the yields fall, the more money they lose. They don't have that nice spread. Now, going back to talking about that rolls us over into what's going on with when do we really know what's going on? I mean, when do we really figure out this market's going to have one hell of a correction or a crash? Because everything we hear every day is how everything is really, really doing well. And it's not. I mean, take a look at what's going on with our labor market's terrible right now. I mean, it's just we have things just aren't good. I mean, do you see what happened that we had with Christmas over the holiday, the retail business? I'm trying to find a number here for you, but we had over the holiday, man, retail really was bad. We'd never seen a holiday, a Christmas holiday, this bad. It just was, they're upside down. So everybody was saying, all the jibber jabbers, right? How great spending was Christmas time, and consumers are strong and they're spending like crazy. It wasn't true. What they saw, the numbers going up, wasn't they increasing their spending. The numbers that were going up reflected the cost of goods were going up. So last Christmas, if they went and they bought a present, a pen, and this was $10 last Christmas, now it's $15 this Christmas. So when they say, look at the numbers, look how much more they're making from this year compared to last Christmas. Well, when you dig back down deep and you see the spreads, they're all just not true. So what you're going to see is when the market's going to crash, okay, first of all, you see sentiment start to go terrible. Sentiment goes south, number one, okay? That's the first thing you see. And there's very little confidence with the consumer. The next thing you start seeing is your 10-year Treasury yield. That starts dropping, and we're seeing that right now. It starts dropping big time, okay? So that means when the 10-year Treasury yield is going down, that means that it's telling you the truth. It's a truth serum. We got retail sales that are weak, labor market's weak, manufacturing's weak. We got everything weak, okay? Just terrible. And also, inflation is expected to go up. The other thing you start looking at is IWM, your small mid-cap stocks. And that's like a bridge between Wall Street and Main Street. Now, it tells you the truth. Wall Street will lie to you with optimism, and then you take a look and you really see what's going on Main Street. What we're seeing is credit is tightening on Main Street. We're seeing economic health is really getting terrible. The consumer's getting weak. Loan demand is collapsing. We're seeing default risk going up. Everything you could think of, earnings, everything is just bad. So to find out really what's going on now, you just have to look at the small mid-cap stocks. You look at IWM, and it will tell you the truth. It'll tell you exactly what's going on in Main Street, what's under the hood, okay? Now, at the end, when you get to the end of the world, it's the credit spreads. It's the credit. That's it. Once you get to that point, it is over. Now, the trouble with the credit spreads, they're the most powerful indicator. There's nothing more powerful of an indicator when the market's going to crash than credit spreads, because it nails it. It nails it. Every crash, you always know when it's going to happen. When you look at the investment grade spreads, you look at the high yield spreads, you see them climbing, never wrong. Tell you it's going to crash, and it always does. And it's so again, and what it's telling you is our defaults are starting to rise. We're starting to see banks pull credit. That tells you everything that bad is going on when you see those investment grade spreads and the high yield spreads starting to go north. It would be nice to see that first, okay? But we don't see that first. We see sentiment first. So it lags. You finally see the truth at the end, but at least real time right now, when you look at IWM, that gives you a real sense of what's going on. But again, your spreads, that's like your last hope, your last chance, the credit spreads. And when they start, they're a lagging indicator, and it takes a long time for those to pop up. It takes a long time. It's like turning the Queen Mary with a rowboat. But when those credit spreads start climbing, so again, you take your investment grade spreads, and if they start going, if they're at 150 or less, everything's fine. 150, they start heading towards 200, And then the high yield spreads, if they're at 300, they're okay, but they start racing towards 500, Now, so it's a lagging indicator. You wish we could see this first. It's lagging behind everything else. Too bad it's lagging. But boy, when you hit that, That's the one that's never wrong, the credit spreads. So you could go study on these. It's no big deal. Credit spreads easy. They make it sound like a big deal. Credit spreads, like they're geniuses. Anybody can look at a credit spread. Just go look it up, and it'll tell you what the credit spreads are. That's the one that's always right. So right now, the big banks, and when the big banks start going down, everything starts tumbling. And then you look at IWM, it tells you the truth. That's happening. Don't listen to Wall Street. Don't listen to the TV. And then when you finally get to see those spreads start moving, that's it. That's the last toll booth. There's no more life rafts. It's over. Check it out, philsgang.com.